Hello everyone, I'm CA Neeraj B. Welcome back to my YouTube channel at the rate Accounting Buddy NB. If you are looking to master journal entries, you are at the right place. In today's video, we will cover accounts associated with purchase and sale of goods, understanding why we debit and credit specific accounts, real life examples of 25 plus business transaction journal entries, plus a question and answer session with MCQs and true and false questions to test your knowledge. So whether you are a beginner in accounting or just looking for an accounting revision, stay with me till the end. Let's dive into the world of journal entries. Understanding the term goods is very important for the purpose of posting accurate journal entry. Goods are physical items which are meant for sale. Goods are physically available with the business as stock in hand, which are either purchased or manufactured with a purpose to sell. It is important for us to understand the purpose for which the goods are bought by the business, as that will decide whether they are recorded as goods or fixed assets. In other words, depending on the purpose of holding a physical item will determine whether the item is classified as goods or fixed assets for a business. For example, if TV, computers, cars, furnitures, etc. are purchased for resale, it is termed as goods and is debited to purchase account. However, if they are purchased to be used for the business, it will be debited to respective asset accounts and not to the purchase account. Let us learn about accounts associated with purchase and sales of goods. First, purchase account. At the time of purchase of goods, purchase account is debited following the accounting rules for expenses. Accounting rule for expense account is debit when increases and credit when decreases. For sales account, at the time of sales of goods, sales account is credited following the accounting rule for revenue accounts. Accounting rule for revenue account is debit when decreases and credit when increases. Let us now talk about purchase return account. At the time when the purchases are returned, purchase return account is credited and not the purchase account. It is credited with the purpose to know the total value of goods returned by the business. While preparing the profit and loss account of the business, purchase return account is deducted from the purchase account and net purchases are considered. Purchase return account is debited following the rules for expense accounts. And accounting rule for expense account is debit when increases and credit when decreases. Let us now learn about the sales return. At the time when the goods sold are returned, sales return account is debited and not the sales account. It is debited with the purpose to know the total value of the sales returns to the business. While preparing the profit and loss account of the business, sales return account is deducted from the sales account and the net sales are considered. Accounting rule for revenue account is applied for recording the sales return transaction. The rule of revenue account is debit when decreases and credit when increases. Regarding closing stock account, it is the value of the remaining unsold stock. It is valued at cost or net realizable value, whichever is less. Let us understand purchase of goods journal entry with an illustration displayed on your screen. On 1st July 24, goods worth $20,000 are purchased and the payment is made by check. In this transaction, the two accounts which are getting affected are goods account and bank account. Let us now understand the reasons of debit and credit for this transaction under traditional classification of accounts and under modern classification of accounts. Under traditional classification of accounts, goods is a nominal account. Therefore, as per nominal account rule, debit all expenses and credit all incomes and gains. Therefore, in this transaction, goods account is debited by $20,000. Now, under modern classification of accounts, goods is an expense and the rule for expense is debit when expenses increases, and credit when expenses decreases. In this transaction, purchase of goods means the expenses of the business are increasing, therefore the goods account is debited. Second account which is getting affected in this is bank account, and the bank account is a personal account under traditional classification of accounts. Rule for personal account is debit the receiver and credit the giver. In this transaction, bank is the giver, therefore bank account is credited. Under modern classification of accounts, bank account is an asset. As per rules of assets, assets are debited when they increase and assets are credited when they decrease. In this transaction, bank balance is decreasing, therefore bank account is credited. Now let us understand sale of goods accounting journal entry with a business transaction displayed on your screen. On 2nd July 24, goods worth $10,000 are sold and the payment is received by check. The two accounts which are affected by this transaction are bank account and sales account. Let us now analyze the reasons of debit and credit of accounts under traditional classification of accounts and under modern classification of accounts. Bank account under traditional classification of accounts is a personal account, and the rule of personal account is debit the receiver and credit the giver. In this transaction, bank has received the money, therefore bank account is debited. Under modern classification of accounts, bank account is an asset account. Rules of asset account is debit when asset increases and credit when it decreases. In this transaction, bank balance is increasing, therefore bank account is debited. Second account of this transaction is sales account. Sales is a nominal account under traditional classification of accounts. Rule of nominal account is debit all expenses and credit all incomes and gains. In this transaction, sales is increasing, therefore sales account is credited. Under modern classification of accounts, sales is a revenue account, and rules of revenue account is debit when revenue decreases and credit when revenue increases. In this transaction, revenue is increasing, therefore sales account is credited. Through the business transaction displayed on your screen, let us understand a business expense journal entry recording. On 1st July 24, salary of $25,000 for the month of June 24 is paid through check. The two accounts which are affected by this transaction are salary account and bank account. Let us now analyze the reasons of debit and credit under traditional classification of account and under modern classification of account. Salary is a nominal account under traditional classification of accounts. The rule of nominal account is debit all expenses and credit all incomes and gains. Therefore, salary being a business expense is debited in this transaction. Under modern classification of accounts, salary is an expense account. The rule of expense account is debit when increases and credit when decreases. In this transaction, salary expense is increasing, therefore salary account is debited. Bank is a personal account under traditional classification of accounts. The rule for personal account is debit the receiver and credit the giver. In this transaction, bank is the giver, therefore bank account is credited. Under modern classification of accounts, bank is an asset account. The rule for asset account is debit when increases and credit when decreases. Through the business transaction displayed on your screens, let us understand payment to creditor journal entry. On 11th July 24, an amount of $2,000 is paid by cash to Mr. Rowley, who is a creditor of the business. The two accounts which are getting affected by this transaction are creditor account and cash account. Let us now analyze the reasons of debit and credit under traditional classification of account and under modern classification of accounts. Mr. Rowley's account is a personal account under traditional classification of accounts. The rule of personal account is debit the receiver and credit the giver. In this transaction, Mr. Rowley is a receiver, therefore Mr. Rowley's account is debited. Under modern classification of accounts, Mr. Rowley's account is a liability account. The rule of liability account is debit when liability decreases and credit when liability increases. In this transaction, Mr. Rowley's balance is decreasing, therefore Mr. Rowley's account is debited. Cash is a real account under traditional classification of accounts. The rule of real account is debit what comes in and credit what goes out. In this transaction, cash is going out, therefore cash account is credited. Under modern classification of accounts, cash is an asset. Rule of asset account is debit when increases and credit when decreases. In this transaction, cash is decreasing, therefore cash account is credited. Through the business transaction displayed on your screens, let us understand the journal entry for the payment received from a debtor. On 15th July 24, business received $5,000 cash from debtor of the business, Mr. Polly, against sales bill number 321. The two accounts which are getting affected by this transaction are cash account and Mr. Polly's account. Let us now analyze the reasons of debit and credit under traditional classification of account and under modern classification of account. Cash is a real account under traditional classification of accounts. The rule for real account is debit what comes in and credit what goes out. In this transaction, cash is coming in, therefore cash account is debited. Under modern classification of accounts, cash is a asset. The rule for asset account is debit when increases and credit when decreases. In this transaction, since cash is increasing, therefore cash account is debited. Debtor account of Mr. Polly is a personal account under traditional classification of accounts. The rule of personal account is debit the receiver and credit the giver. In this transaction, since Mr. Polly is a giver, therefore Mr. Polly's debtor account is credited. Under modern classification of accounts, Mr. Polly's debtor account is an asset. The rule for asset account is debit when increases and credit when decreases. In this transaction, Mr. Polly's debtor account is decreasing, therefore Mr. Polly's account is credited. Illustration on your screen is analyze the transaction, state the nature of accounts and the account that will be debited and credited as per traditional classification of accounts. Transaction T8 on your screen is Tolly started business with a capital introduced in cash for $50,000. If we analyze this transaction, the two accounts which are getting affected are cash account and capital account. Cash is a real account and the rule for real account is debit what comes in, while capital is a personal account and the rule for personal account is credit the giver. Therefore, both the accounts are debited and credited by $50,000. Transaction T9 on your screens is a bank account is opened by depositing the cash amounting to $20,000. If we analyze this transaction, the two accounts which are getting affected are bank account and cash account. Bank account is a personal account and the rule is debit the receiver, while cash is a real account and the rule for real account is credit what goes out. Therefore, in this manner, the transaction is recorded for $20,000. Transaction T10 is business received a loan from Polly by a check amounting to $75,000. The two accounts which are getting affected by this transaction are bank account and the loan from Polly account. Bank is a personal account and the rule for personal account is debit the receiver. Now the loan from Polly is also a personal account and the rule for personal account is credit the giver. Therefore, in this manner, the transaction is recorded for $75,000. Another illustration on your screen is analyze the transactions, state the nature of accounts and the account that will be debited and credited as per traditional classification of accounts. Transaction T11 on your screen is business purchased furniture in cash from Homebox LLC for $2,000. The two accounts which are getting affected are furniture account and cash account. Furniture is a real account and the rule for debiting the real account is debit what comes in. Cash is also a real account and the rule for crediting a real account is credit what goes out. Therefore, in this manner, this transaction is recorded for $2000. Transaction T12 is business purchased furniture from Home Interior LLC for $5,000. If we analyze this transaction, the two accounts which are getting affected are furniture account and the creditor account of Home Interiors LLC. Furniture is a real account and the rule for debiting a real account is debit what comes in. Creditor account of Home Interior LLC is a personal account and the rule for crediting a personal account is credit the giver. Therefore, in this manner, the transaction is recorded for $5,000. Transaction T13 is business purchase goods worth $10,000 for cash. The two accounts which are getting affected are purchase account and cash account. Purchase is a nominal account and the rule for debit for nominal account is debit all expenses and losses. Cash is a real account and the rule for crediting a real account is credit what goes out. Therefore, in this manner, the transaction is recorded for $10,000. Another illustration on your screen is analyze the transactions, state the nature of accounts and the account that will be debited and credited as per traditional classification of accounts. Transaction T14 on your screens is goods purchased from Goli Trading LLC for $25,000. The two accounts which are getting affected are purchase account and Goli Trading LLC. Under traditional classification of accounts, purchase is a nominal account and the rule for debiting the nominal account is debit all expenses and losses. In this transaction, purchase being the business expense is debited to purchase account. Goli Trading LLC is a personal account and the rule of crediting personal account is credit the giver. In this case, goods are being given by Goli Trading LLC on credit. Therefore, Goli Trading LLC account is credited. Under this manner, this transaction is recorded for $25,000. Transaction T15 is goods worth $12,000 are sold to Toli for cash. The two accounts which are affected by this transaction are cash account and sales account. Cash is a real account and rules for debiting real account is debit what comes in. In this transaction, since the business has received the cash, cash account is debited. Sales account is a nominal account and rule for credit of a nominal account is credit all incomes and gains. In this transaction, sales being the income of the business is getting credited. Therefore, in this manner, this transaction is recorded for $12,000. Transaction T16 is goods worth $25,000 are sold to Molly. The two accounts which are getting affected are Molly's debtor account and sales account. Molly's debtor account is a personal account and rules regarding the personal account is debit the receiver. Sales is a nominal account and the rule for crediting the nominal account is credit all incomes and gains. Therefore, in this manner, this transaction is recorded for $25,000. Another illustration on your screen is analyze the transaction, state the nature of accounts and the account that will be debited and credited as per traditional classification of accounts. Transaction T17 is business received $20,000 cash from Molly. The two accounts which are getting affected by this transaction are cash account and Molly's debtor account. Cash is a real account and the rule of debiting a real account is debit what comes in. Molly's debtor account is a personal account and the rule for crediting a personal account is credit the giver. Therefore, This transaction is recorded for $20,000 by debiting the cash account and crediting the Molly's debtor account. Transaction T18 is check for $25,000 is paid to Guli Trading LLC. The two accounts which are getting affected by this transaction are Guli Trading LLC account and bank account. Guli Trading LLC is a personal account and the rule for debiting a personal account is debit the receiver. Bank is again a personal account and the rule for crediting a personal account is credit the giver. Therefore, this business transaction is recorded for $25,000 by debiting the Guli Trading LLC account and crediting the bank account. Transaction T19 is interest of $500 paid to Molly in cash. The two accounts which are getting affected are interest paid account and cash account. Interest paid account is a nominal account. Rule for debiting a nominal account is debit all expenses and losses. Cash is a real account and the rule for crediting a real account is credit what goes out. Therefore, this business transaction is recorded for $500 by debiting interest paid account and crediting cash account. Another illustration on your screen is analyze the transaction, state the nature of accounts and the account that will be debited and credited as per modern classification of accounts. Transaction T20 on your screen is Tully started business with a capital introduced in cash amounting to $50,000. The two accounts which are getting affected are the cash account and the capital account. Under modern classification of accounts, cash is an asset and the rule for debiting an asset account is debit when assets increase. Capital introduced is recorded in the capital account and the rule for crediting capital account is credit when capital increases. Therefore, this business transaction is recorded for $50,000 by debiting cash account and crediting capital account. Transaction T21 is a bank account is opened by depositing cash amounting to $20,000. The two accounts which are affected by this transaction are bank account and cash account. Under modern classification of accounts, both cash and bank account are assets. The rule of debit and credit is debit when assets increase and credit when assets decrease. Therefore, this business transaction is recorded for $20,000 by debiting bank account and crediting cash account. Transaction T22 is business received a loan of $10,000 from Polly by check. The two accounts which are getting affected are bank account and loan from Polly account. Under modern classification of accounts, bank is an asset while loan from Polly is a liability. An asset account is debited when it increases and liability account is credited when it increases. Therefore, this business transaction is recorded for $10,000 by debiting bank account and crediting Polly's loan account. Next illustration on your screen is analyze the transactions, state the nature of account and the accounts that will be debited and credited as per modern classification of accounts. Transaction T23 is business purchased furniture in cash from Homebox LLC for $2,000. The two accounts which are getting affected are furniture account and cash account. Under modern classification of accounts, both furniture and cash are asset accounts. The rule of debit and credit for asset account is debit when assets increases and credit when assets decreases. Therefore, this transaction is recorded for $2,000 by debiting furniture account and crediting cash account. Transaction T24 is business purchased furniture for $5,000 from Home Interiors LLC. The two accounts affected by this transaction are furniture account and Home Interior LLC account. Under modern classification of accounts, furniture is an asset. An asset account is debited when asset value increases. Home Interior LLC supplier of furniture is a liability account and the liability account is credited when liability increases. Therefore, this transaction is recorded for $5,000 by debiting asset account and crediting Home Interior LLC creditor account. Transaction T25 is business purchased goods worth $10,000 in cash. The two accounts which are affected are purchase account and cash account. Purchase is an expense account. As per expense account rule, expense account is debited when expenses increases. Cash is an asset account, and as per asset account rule, assets are credited when the assets decrease. Therefore, this transaction is recorded for $10,000 by debiting purchase account and crediting cash account. Question number 11 is, what is a simple journal entry? The answer is a journal entry involving only two accounts, one debit and one credit, is called a simple journal entry. Question number 12, what is a compound journal entry? The answer is a journal entry involving more than two accounts, multiple debits or multiple credits, or a combination of both. Question number 13, what is a reversing entry? The answer is a journal entry made at the beginning of the accounting period to reverse an entry passed at the last day of the previous accounting period is called a reversing entry. Question number 14. What is a correcting entry? The answer is a journal entry made to fix an error in a previous or an earlier entry is called a correcting entry. Question number 15. What is a closing entry? The answer is a journal entry made at the end of an accounting period to transfer temporary accounts to a permanent account is called a closing entry. Question number 62 is, bad debts earlier written off and now recovered are credited to. The available options are option A, bad debts account, option B, bad debts recovered account, option C, debtors account, and option D, miscellaneous income account. And the correct answer is option B, bad debts recovered account. Question number 63 is, a simple journal entry is, and the available options are option A, any entry with multiple debits and credits, option B, any entry with no debits, option C, any entry with one debit and credit, and option D, an entry with only debits. And the correct answer is option C, any entry with one debit and credit. Question number 64 is, what type of account is unearned revenue? And the options available are option A, asset, option B, liability, option C, equity, and option D, revenue. And the correct answer is option B, liability account. Question number 92 is, increase in assets are debited and decrease in assets are credited. This is a true statement. Question number 93, discount allowed to customer is an expense for business. This is a true statement. Question number 94, proprietor's drawing account is a nominal account. This is a false statement. Question number 95, creditor's account by nature will have a debit balance. This is again a false statement. Question number 96, some of the business transaction will affect only one account. This is a false statement. Question number 97, the left hand side of an account is called the debit side. This is a true statement. Question number 98, for every debit there is a corresponding credit of equal amount. This is again a true statement. Question number 99, staff salary when paid are credited to staff salary account, which is a false statement. Question number 100 is, narration should be written in the journal. This is an absolutely true statement. In my upcoming video of part 3 in the series of journal entries on 8th March 2025, we will master the technique of journal entries with the help of 7 more illustrations. We will also discuss in detail about rebate and discount and the journal entries related to them. If you enjoy the content and appreciate my teaching style, please subscribe, share and like my YouTube channel at the rate Accounting Buddy NB. Thank you and goodbye for now.